As we recap the third quarter, let's remember that third quarters tend to be highly volatile time periods. Why do you think that terminology, sell in May and go away, was coined? That's because equity volatility tends to see its biggest spikes in the summer months. In fact, it's not even uncommon to see the S&P 500 register 2 back-to-back monthly declines during this summer. Now, this summer, we saw a lot of volatility from sources that are not new news. The U.S.-China trade war definitely drove volatility higher this summer. You also had the ongoing uncertainty surrounding Brexit. But there was some new news this summer that really sparked volatility. And if you look at this chart is called the World Uncertainty Index, and it looks at a lot of different factors that come from economic, political, and policy conditions across 140 different countries. And what you saw here is that uncertainty index spiked higher than we saw even when we were talking about the breakup of the European Union. It was higher than 9/11. It was even higher than the post-Brexit vote that surprised the markets. Some of the other factors, though, that were a little bit newer news was that the trade war was really starting to filter into some of the economic data. China's growth was significantly slowing down. In fact, it was slowing down to multi-decade lows. We have Germany now that is nearing a recession. Some of the economic data in the U.S. started to weaken. We also had civil unrest in Hong Kong. We had some short-term liquidity concerns in the fixed income market here in the U.S. We had inverted yield curves that spooked the markets. These were some of the other factors that drove volatility higher in the third quarter. So let's take a look at what that translated into from the asset class perspective. Let's start with the global equity performance. If you look at the global equity index, the MSCI All Country World Index, that actually ended the quarter flat. And that is extremely impressive, especially since you saw the worst August for that index in nearly 4 years. In general, U.S. and Japanese equities led the global equity returns. Despite that volatility that we saw in August, we actually did get another record high in U.S. equity indices during the quarter. Now, if you look at some of the international returns, the international, especially the emerging market equities, they really were the ones impacted the most by the volatility we saw throughout the quarter. Now, the biggest surprise for the quarter was the move in fixed income, specifically in the long-term Treasury yields. The U.S. Treasury Index, it rallied for the fourth consecutive quarter, but it was really those long-term bond yields that posted actually equity-like returns, with the 30-year Treasury bond yield hitting a record low. Now, on balance within fixed income, it was really quality over yield, as investment grade and treasury bonds actually outperformed high yield and emerging market debt. And then when it came to the commodity returns, what we saw is those commodities that were sensitive to Middle East tensions, like energy, or sensitive to the global trade tensions, like the agricultural commodities, they suffered in the third quarter. But the precious metals that are more sensitive to the volatility in the market, they actually rallied. One of the big takeaways we get from the third quarter is that we think investors are still getting driven by those regular headlines. They're being driven by emotion and momentum and not underlying fundamentals. We saw that with what happened in the fixed income market. When we talk about volatility, most of the time investors think equity market volatility, but bond investors really got to see what volatility meant in the third quarter. You saw that with the 30-year bond yield seeing its fastest, steepest drop since when we were talking about the European Union completely breaking up. We saw a record low yield on the 30-year Treasury bond. So as we step back, here at Verdence, we like to look past those headlines. We like to look at the underlying fundamentals and valuations when it comes to recommending the appropriate asset allocation, especially as we move into the final quarter of this year.